क्या कर रहा है यार? You look very stressed.
Yeah, 31st is coming now, so I'm just figuring out my tax saving plans.
हाँ मतलब डेट पास में है, but make sure जल्दबाजी में कुछ काम मत करना. We tend to make mistakes when we're in a rush.
So what do I do?
Let me tell you. These are the 4 mistakes that you need to avoid while making a tax saving plan at the last minute. Mistake number 1. Not accounting for existing investments. Do you even need to commence the tax saving exercise now? If you look closely at your portfolio, you might not even need to. Confused? Let me break it down for you. If you're a salaried employee, your Employees Provident Fund or EPF contribution will take care of a substantial chunk of Section 80C's Rs 1.5 lakh deduction limit. Some taxpayers end up making tax saver investment to exhaust the 1.5 lakh rupees limit without ascertaining whether they need to make any investments in the first place. So if you're a salaried employee, look at your payslip to figure out the amount of EPF contribution deducted from your salary every month. Taxpayers with children should also take into account tuition fee paid to schools and colleges during the year. Take stock of these 2 deductions before hastily investing a large sum of money in other tax saving schemes just to meet the deduction limit. Mistake number 2. Buying long-term insurance plans. Have you noticed an increase in the phone calls from life insurance agents pitching you to buy endowment plans that will give lump sum return at maturity? These agents will offer to handle all your paperwork with minimal inconvenience to you. A helping hand when you are racing to beat the deadline looks luring. But the number of such calls have gone up because the recent changes announced by Finance Minister Nirmala Sitharaman during the budget speech.
Another proposal with similar intent is to limit income tax exemption from proceeds of insurance policies with very high value.
To put it simply, the income earned at maturity will be taxed if the aggregate annual premium paid exceeds Rs 5 lakh. The agents who are trying to push such policies with high premiums but low returns have lucrative commissions and not your financial well-being on their mind. Financial planners say that it is best to separate investment from insurance. So it is always advisable to buy a term insurance policy as a life cover and not as an investment or tax-saving tool. For saving tax, one can look for other available investment options. Mistake number 3. Swiping credit card to buy policies. One of the biggest drawbacks of making a last-minute tax plan is the unavailability of liquid funds, especially at the end of the financial year. If you have not started tax planning earlier in the year, there's a possibility that you could face a liquidity crunch while trying to beat the deadline. This could compel some taxpayers who are short of funds to swipe their credit cards to buy tax-saving instruments such as life insurance policies. Now you may end up saving on taxes, but you will definitely fall into a debt trap if you don't have a plan of action to repay payments made by credit card on time. Credit cards come with a steep interest rate and paying just minimum balance is not enough. It is best to use a credit card as just a spending and not a borrowing tool. And use it only when you are confident that you can pay off the bill in the following billing cycle. Mistake number 4. Leaving tax planning to March. Completing the tax saving exercise in March rather than in the early part of the financial year is the biggest mistake you must avoid next financial year. Postponing the task to the end of the year leads to several challenges. For one, you could fall short of funds in March to make a huge investment in one go. Adopting a systematic approach towards tax-saving investments will ensure that you do not feel the heat in March. If you have no EPF deduction and no other investments and you want to invest 1.5 lakh rupees, you can start an SIP with monthly investments in an equity-linked savings scheme at the start of the financial year. Under these schemes, stipulated payments have to be made on a monthly basis, so you won't have to feel the pinch of spending a huge amount in one go. Moreover, unlike a lump sum investment, a systematic approach will help you tide over turbulent market conditions. If you still haven't done your tax planning for the financial year 2022-2023, you should do it right away. You just got a few days left. But for the next financial year, make sure you start your tax planning as the year begins.
Thanks, man. I'll make sure I do all my tax savings at the beginning of the year.
Exactly. And if you haven't made a tax saving plan yet, it's not too late. You can watch our video on the 5 tax saving instruments you need to make a plan. And for more such content, keep watching the Moneycontrol channel.